Welcome to another ESCoE economic measurement webinar with a COVID-19 focus. As you're aware, the majority of traditional indicators, official indicators in particular, generally get published with a lag of days, weeks after the reference period. But when you have a sizable shock in the economy, national or even in this case international, like COVID-19 and government initiated lockdowns, timeliness, quality, accuracy, relevance, etc. become very, very important. So during this year, we've had a rapid expansion in the availability and the use of faster indicators, both in the UK and abroad. This presentation will set out some of the main issues faced by our central bank in the UK, the Bank of England, in incorporating such faster indicators and the use of data science techniques, which are feeding into their assessment and obviously links data, whether it's official, whether it's unofficial, whether indicators, actual, in terms of informing the link to policy. What we will have is points for clarification if you want to raise them in the chat. We'll have question and answers at the end. Again, if you raise that in the question and answer box, and we'll call upon you if you want to speak as well. We can unmute as appropriate. It's also worth noting that the webinar will be recorded, and thank you in advance for that. So I'd like to say thanks to the two presenters today, Nick Bate and Alastair Firrell from the Bank of England in advance. And without any further ado, I'll hand over to Nick and Alastair. So Nick, if you can share your screen and off you go. Thank you.
Okay, great. Thanks very much. Could I just check people can see my screen okay?
Yes, we can.
Great, thanks very much. Okay. Well, thanks very much for joining Al and I for this webinar today. We're going to take you through some of the work the bank has been doing over the last few months, bringing faster indicators into our assessment of the economy. So I'm Nick Bate. Here we go. I work in the current economic conditions division of the bank, and Al is a principal data scientist in the advanced analytics division of the bank. Now, having an economist and a data scientist host this webinar sets out one of the themes that we'll touch on time and time again over the next hour or so, that integrating faster indicators into our analytical toolkit has really benefited from merging both economists and data scientists' skills in order to try and develop the best product that we can. So what am I going to cover today? Well, four main things. Although we have a lot more material on the third section here than on the other ones. So firstly, what was the problem with the old toolkit? Why bother looking at faster indicators? Well, the title of this webinar is Necessity is the Mother of Invention. So that tells you that we basically had to, but I'll cover why in a minute. Secondly, what are we looking for from faster indicators? Well, the bottom line is that the NPC have to set monetary policy, so giving them the best information we can on what's going on in the economy helps them make more informed decisions. And COVID has had vastly different impacts on different sectors of the economy, where in normal times, much of the economy moves more closely in lockstep. So trying to get a handle on those differences is very important. Thirdly, we'll go through how we went about it. As I said, lots of collaboration between economists and data scientists. Related to that, there can be various technical issues to consider along the way, some of which Al will run through. And then I'll show you some of the faster indicators that we're looking at. Finally, what lessons have we learned along the way, and an eye on what might be next. I don't think this is anywhere near the end of the journey, even for the faster indicators that we already have. So let's get into the first of those. What was wrong with our existing toolkit? And there's essentially two main points here. The first is timeliness. This chart shows a simple timeline of the main economic data releases. So the UK went into lockdown in late March, but as you can see, we weren't going to get March GDP data 7 weeks later. And even that March data would only include about 1 week of lockdown, it wouldn't be until nearly mid-June that the full effects of the pandemic in the April data would have been seen. Now, with the benefit of hindsight, the economy actually seems to have troughed by mid-April. So by the time we got the first inkling of what damage had been done, even in the first week of lockdown, the economy was already starting to inch up by then. And by the time we knew the full damage from the lockdown in April GDP data, we were about to get a big upsurge as the non-essential shops reopened again. Now, you do get business survey data more quickly than the official data, but we'll come on to how usable those surveys were in measuring the downturn in a minute. So the broader point here is that we really couldn't wait for the usual indicators to come along. Economic activity was falling at an exceptional pace, with different parts of the economy being hit in vastly different ways. So we had to try and find ways to monitor and assess that. It's still the case that the official data are the ultimate benchmark, but the question is, can you get a steer on that data more quickly with faster indicators? So that was the first problem with the existing toolkit. The second problem relates to how standard indicators have mapped into GDP over the last few months. So even if they had been available in real time, what signal would they have provided? Well, basically the relationship between various typical indicators of activity and GDP have broken down over the last few months for a variety of reasons, and here are some of those. Some business surveys are net balance surveys. They measure the number of firms whose output's going up versus down. Now, in normal times, they do a good job, but when you get to more extreme outturns, they seem to cover more the breadth of the downturn rather than the magnitude. Now, in normal times, the former is a pretty good proxy for the latter, but they haven't been in recent months. Another issue is that the surveys are bounded by 0 or 100. Again, they haven't been able to capture the magnitude of the downturn in the spring or the extent of the recovery since then. And the final point is that some firms seem to have been answering questions about changes in output in levels terms. At face value, some surveys suggest that output has continued to decline throughout the last few months, whereas official GDP has shown quite a sizable rebound. Just to demonstrate this, these charts show the composite PMI mapped against month-on-month and 3-month-on-3-month GDP. So based on pre-COVID relationships, the PMI would have had to have fallen to a level around -150 to capture the magnitude of the fall in GDP. That's impossible. The PMI is bounded at 0. Now, you could come up with new quadratic or cubic relationships between the PMIs and GDP if you wanted to, but they would seem a bit ad hoc and without much grounding. And even then, the models wouldn't have fitted very well throughout the last few months as a whole. So basically, both Timeliness and old models breaking down with a motivation for exploring faster indicators. Moving on to the next topic, what are we looking for from faster indicators? Well, the first answer is anything. If your old models don't work, then anything is better than nothing. And I've just covered how that was the case. The second answer is everything. As I flagged at the start, COVID has had such different impacts on different sectors of the economy that you're looking to get as much of an insight into all of those differences as possible. Again, that's different from normal times when the business kind of top-down business surveys would work. In terms of those differences, just think about pubs versus supermarkets. Pubs forced to shut, supermarkets benefiting from people working from home, buying more food from close to home rather than near the office. Think about in-store versus online, which we can come on to in a minute in the official retail sales data. So now, while much of what we'll cover has been looking at the economy in the context of COVID, fortunately, we did have a bit of a head start on some of these faster indicators, and that was thinking about the possibility of a no-deal Brexit going back 18 months or so. So I'll just cover something on that quickly. Now, one of the main concerns around the possibility of a no-deal Brexit is potential blockages at ports. If you do a quick Google search, those tailbacks could be any of 12, 30 or 93 miles long. So one thing we did was start to look at traffic monitoring, particularly around ports. Now, Highways England have thousands of traffic sensors all over the country measuring traffic flows. The left-hand side shows a broad overview of where they are, bottom line being all over the place, but predominantly on main roads. They can capture the length of a vehicle, so you can differentiate a car from a lorry. They can sometimes tell you which lane the vehicle's in, and they can also sometimes tell you the speed. So what if you pick out some of those traffic cameras which are on the main routes into and out of ports? Well, the right-hand side here shows a bit of a close-up of Dover, which is here, and all of these blue dots here are various sensors, and this is the M20, the main road, coming into Dover. But you can pick out other ports as well across the country. So if you pick out the number of lorries going through some of these traffic sensors, you can maybe get a decent proxy for the volume of lorries going to port. As I said, you can do this for other ports, but we focused on Dover here. And these are the kind of outputs that you can get. So the left-hand side shows cumulative weekly flows of cars and lorries from one of these sensors. This was last autumn rather than this autumn. Obviously, if there's massive backlogs at ports, you might expect to see some pretty big changes in these numbers. On the right-hand side, shows you can cut the data at hourly intervals in some places, and also the lanes of the vehicles. So here's the inside lane, and good to see all the lorries basically staying on the inside lane, not in the outside lane. And again, you might expect to see some quite big impacts here if there were big backlogs of lorries. Now, this was something we've been looking at we looked at then in a Brexit context, but we've also been looking at it from a COVID angle as a proxy for how much exports and imports might have been hit by the pandemic. We've also used it in a couple of other places, which I'll come on to in a minute. So that's a flavour of some of the faster indicators work we've been doing over the last few months. But getting this Highways England data in real time requires quite a bit of technical knowledge, far in advance of what your average economist like me would automatically know how to do. So what I'm now going to do is hand over to Al to talk through how we went about investigating some of these faster indicators, both from a collaboration perspective and from some technical perspectives as well. So I'll stop there and hand over to you, Al.
Thanks, Nick. Right, let's talk then. We've seen an example, and we'll see a number more examples later of exactly sort of the kind of things we're looking at. But let's talk about how we went about it. And there's 6 things here that that I'd like to run through. The first and the most important, if we can drop to the next slide, please, Nick, is about partnerships. So we talked about economists and data scientists. It's not even just that. We're involving statisticians in the building, IT technicians, the whole range of people. And this has been absolutely the crucial element of this kind of work, that unless we're all understanding each other and bringing different skills together, this is what's making this all happen. So it's partly about addressing the key questions, that we've got people who have various skills, but unless we all know what we're aiming for, and we all know exactly what the most important things that we're looking for are, then we can bring them together. We're then getting multiple points of view. And at this point, one of the first key factors is trying not to self-filter. So not to kind of go, oh, we'd really like to see this, but we know we can't have that. So maybe we should go for this instead. What one person thinks is impossible, or on the flip side thinks, well, we could get them that, but they wouldn't need that. Someone else might be going, that would be amazing, or that would be really easy to do. So this covers a whole load of aspects, from data we can get at, analytical techniques we can use, outputs we can bring, methods to automate, data that's too large to handle. The example there is one person's massively big data that's too big to deal with. It's another person's completely standard. Yeah, we've got this covered. So the point that overrides all of this is working in partnerships and bringing people with different skills together. If we move to the next slide, this partnership aspect helped us to kind of think big. So to try different things out. And this is for a number of reasons. Nick talked about, one, the need that we just didn't have anything, but also that times are different. So rather than looking for a single silver bullet, one overarching nice stat on consumption or on trade, actually those narrower stats are exactly what we want to see, because they're showing up the nuance, they're showing the difference between online and in-store, or between supermarkets versus pubs. So we're not looking for a direct replacement, partly because there isn't one, but we're going to try and get lots of different pieces of the puzzle and bring them together. How do we go about finding these things? Some of it is just thinking creatively. So what can we get hold of that might give us a window onto a particular area? It might be perfect, might be exactly what we want to see, or it might just give us an idea. So there's been plenty of research and work done on using internet searches as a proxy for the actual purchases or interest or people taking on debt, unemployment, all of these kind of things. So can we find proxies that map onto the actual data we want? So to do that, we've scanned academia, public domain, what other institutions are doing, and really building on other people's ideas as well as our own. The next thing in this is just trying things out, just being willing to accept that we're going to have a go at lots of things and they might not all work. So it might be that we want to get the data, but we can't. We get it, but it's not good enough. It's not to work with, it's not timely enough. Or it might give us a flavor. It might not be perfect, but it might give us a bit of extra information. And so being willing to take lots of things, try them out and build them up is definitely important, rather than just holding out for the one big killer fact. To stand alongside that, trying things out and getting them done, there's a point about speed. So getting to the first cut as fast as possible, see if it's any good. And if it is, great. We'll refine it, we'll improve it, we'll make it more robust. If it's not, toss it away and go for something else. If we can skip to the next slide, I've been talking a little bit in the abstract here. Here are some of the types of data that we'll be looking at. So these span consumption, so shopping, restaurants you can see in there. We've got travel and mobility. So lots of things about anything from cycling to public transport to flights. The sensor data that Nick was talking about earlier about traffic on the roads, that can speak to trade. We've got things about job vacancies in there as well. And the point here is really, it's about variety. Some of these are quite narrow, some of them are much broader, but they're building up a picture and we use them together. There's plenty here, and that's not absolutely everything we've tried. But how do we avoid getting overwhelmed then with all of these things and trying to bring in all of these data sets? If we can bring to the next slide. A lot of the cost of doing this is reduced by building on other people's work, or building on other work by ourselves or other people. So some of this was data we were already collecting, for example, traffic monitoring. Some of it was using code that we already had on the stocks, but maybe we're using for working with something else. So interfacing with APIs, there's application programming interfaces, nice, easy ways to grab data in a good standard format, or working with databases. Some of this was around the outputs. So for example, generating slides with chart content, or nice standard clean charts in a good format straight away. Some of this is about dealing with non-tabular data, so not your standard kind of CSVs in Excel, but dealing with JSON or XML. On top of work that we've done in the past, we were very happy to use ready-made data sources where we could. So real high quality ones where you can put in search parameters and bring back exactly what you want, and combine those with more bulk lift and shift, grab whatever you can and then filter your own. And the fourth point of there, using other people's code and ideas. So for example, plenty of R and Python packages for things like downloading Google Trends data from Gtrends are there, or Google mobility data. So looking at mobility around the country or even around the world, and building on work that other people have done even with that. So you may have seen, for example, John Byrne Murdoch from the Financial Times, who did some great work and published his code on how to extract Google mobility data and use it. Well, great, we can bring that in and gather that. And I think it's important when we're talking about using and building on all of these things that other people have shared, sharing back then becomes really important too. So sharing within the organization, so everybody knows what you're doing and what's possible, but also sharing out to the community wider. If you develop new tools, making them available. So these kind of building blocks allowed us to go and get out lots and lots of different data sources, bring out lots of different outputs. But that still can potentially be increasingly overwhelming for the teams who are developing these things, as each one might take more and more time to run and to maintain. So if we just jump to the next slide, there are certain practices which really helped us to not get overwhelmed by all of these things, to enable a small team, a few people, to be able to keep developing and not have to stop because they run out of time or ability to maintain. And that's really about using robust processes. So using real standard libraries and standard patterns, that makes things quick to develop and easy to check too. Using good development practices, things like version control, configuration files, modular code, these kind of things make it easier to work together and make things much faster to change. So you're iterating, you're changing, you're finding things that need improving, are not quite what we want. They need to be quick to go into and jump around, and we don't need to be relying on an individual person to do these. And then talking about automation. So in order to have time to do all these things, we don't need to have somebody needing to run a whole suite of scripts every morning or 5 times a day at a particular time. So automating these things, getting them running on a schedule, then that also means error handling and logging out errors so that we can see what's happened if something's gone wrong. Monitoring those jobs. So this little thing down in the corner is a little dashboard we built just to keep an eye on all of the scheduled tasks that are running and see which ones have run. So we can get a flag in the morning that says, actually, do you know what? This one hasn't run, somebody needs to go and have a look at it. And even just down to expecting there to be issues with certain things. If we're collecting data off the web, sometimes web connections go funny. Sometimes sites have problems and we need to go and retry, or changes get made and we need to move with them and past them. So we've talked about technical processes a bit here. How about analysis? If we can jump to the next slide. There are plenty of analytical tools in the toolbox, and certainly we've used a whole number of them. Standard explanatory analysis, time series, forecasting, natural language processing. But the key with most of these is starting simple. Simple may well be good enough as a start. And if it's not, it's still a decent benchmark to test your more complex processes against. Accuracy versus explainability is a big deal. So if we're building models here, we need to know whether we're happy if it's just right, or whether we need to know the exact components that are feeding in. Because if so, then there's no point us looking at real black box models that are hard to unpick. So really the consideration here is about using the right methods for the job, depending on what we want to do, and also choosing the right visualizations that we need. So that might be static charts in slide decks or interactive dashboards that areas can jump in and interact with and effectively make multiple queries from the same dashboard. And here automation doesn't just help with time saving for grabbing data, it also extends the scale and the scope of analysis. If you can churn out a sort of Cartesian product of charts, you know, all currencies, all dates, all countries, all types, and then review and decide on which the best ones of these are, and then run with them, you can get a much faster sort of bang for the buck. So I think the last point I'd like to make in this section is just about trying to get to know your data. And if we can move to the last slide there. There's always with these things going to be limitations. This is new data sets that we're using. So we might not be entirely familiar with them like we would have been with our sort of classic and standard indicators that we've used before. We don't necessarily have a long background of the data. We need to think about the collection approach. Has it been sampled? In which case, sort of, do we know how? Are there potential restrictions or limitations? Is there inconsistency over time? Can we factor that out into a sort of more macro adjusted way? Or do we just need to understand the approach and understand the limits to what we can draw from them? If we're creating models, we need to try and get a good benchmark for those and validate them. And indeed understand the cost of false positives versus false negatives. Do we want to err on one side or the other to make sure that we're not really jeopardizing our analysis? And we talked about proxies here too. So a mismatch between the data that we have and the target variable we really want. So again, this is thinking about what the mismatch is between. Is there research we can use to help us understand them? How far can we really draw our conclusions? And can we start moving from proxies towards direct measures? And we'll see some of those later on, where we made a start with proxies and we're able to actually pick up direct measures after a while and replace those proxies. So I think that's a nice summary of the technical kind of things we were dealing with. So now Nick's going to show you a few examples of exactly what we're talking about here.
Okay, thanks very much. So that's basically how we went about the process. What kind of faster indicators are we looking at now? Well, we've shown some in the last few monetary policy reports starting in May, but we'll go through some more here as well. So to begin with, consumer spending is around 2/3 of GDP, and there's quite a few consumer-related faster indicators out there. So here's a framework about how we've been thinking about consumer spending over the last few months. So basically, we've got 4 different buckets of consumer spending here, each of which will be affected by COVID in a different way. The first is social spending, so things you do which require interacting with other people or being close to others, so air travel, cinema, theatre, restaurants, things like that. You'd expect this to be hard hit by COVID, not least owing to the direct restrictions on some of these things. Next is delayable spending. This is largely retail and spending on cars. Now this will also be hit by direct restrictions, but with a couple of big differences from social spending. Firstly, you can buy quite a few of these things online, so you can still get them even if the shops are shut. That's not the case with social spending. You can get takeaway food, but you can't go on holiday whilst you're under lockdown or something like that. The second difference is that there's more scope to catch up with consumption of these goods once lockdown ends. If you don't buy a new car or a new TV today because the shops are shut, you can always go and get one tomorrow. So over a longer period of time, your consumption is broadly unchanged. In contrast with social spending, if you can't go to a restaurant for a month, you're not going to go every single day to catch up on what you would have done. Third block is work-related spending. So this will obviously be affected by people working from home, not spending money on travel fares or petrol, things like that. And then finally, the staple items, supermarket food and drink might go up, given that people can't go to restaurants as much and people aren't going to the office to buy food from there as much. Utility bills also might go up if people are working from home. So basically, all of these things will be affected by different ways by COVID. So as I run through various faster indicators, it's worth bearing in mind which part of consumer spending they're tracking. And as you'll see, it's easier to find faster indicators for some parts of spending than others. Now, I'm not going to go through all of these different boxes, but as it happens, I'll start with the first one, which is air travel. So COVID obviously originated abroad and initially hit other countries harder than the UK. So one of the first places you started to see here shows total number of flights from the UK's largest 6 airports collected from OpenSky. Obviously, you can see the big impact that COVID had initially and then weakening again more recently. But you can also do this exercise for other countries. So what you saw at first was flights in other countries, think China, think Italy, being hit significantly. You can also cut this data in different ways. The right-hand side shows flights by some of the different airports. Obviously, Heathrow is the largest, but there's other ones here as well, and all been affected by COVID. You can also cut it by carrier if you want to. So in the early stages of COVID, you can see that some of this impact was because of the closure of Flybe. But you can also look at other carriers too, and to some extent they go hand in hand with the airport numbers if they have a big hub there. You can also look at cargo flights if you want to, although there aren't actually that many of them. A lot of cargo is actually flown in the bellies of passenger flights. So you can get very detailed flight data. Now, what we're doing here is using mobility as a proxy for economic activity. We don't know how many people are on the flights. We don't know if they're in first class or economy. So it's by no means a perfect measure of spending. But if your normal models don't work and you've nothing else to do, nothing else to go on, sorry, then that's fair enough. But the relationship between mobility and spending can change, which I'll come on to later. And that's part of the learning process from a standing start about many of these faster indicators. So moving on to other mobility indicators, and there's a lot of them around. They're probably the most widely used faster indicator out there, so I won't spend that long on them. I'll show you some other things instead. But here's a couple of Apple mobility charts. On the left-hand side shows trends in driving, walking and public transport since the start of the year. The effects of COVID in the spring are pretty clear, but then some recovery. Since then, public transport lagging somewhat though, perhaps not surprising given that it requires interacting with strangers. And as you can see, they've all headed down a bit over the last few weeks as greater social restrictions have come in. Some of these charts don't include the latest data. The point of this webinar is not to go through the latest state of the economy today, but just to give an overall flavour of faster indicators. The right-hand side shows you can cut the data different ways. So what we've done here is group up. Before England went into full lockdown, there's the tiering system, tiers 1, 2 and 3. So you can group them up into those different buckets. And as you can see, this is driving. Driving in tier 3 was being hit a bit more than tiers 1 or 2. Wales went into a full lockdown before England did, so you can see here Cardiff faring particularly weakly on the mobility side of things. So you can start to use these indicators to get a handle on some of the effects of lockdown. This was Apple. Similarly, Google mobility data highlights some of the changes in the economy since COVID. More people working at home, so residential going up there, and less people doing the usual workplace. And the yellow there, an indicator of footfall at retail and recreational. So this might gives you more information on people's habits since COVID. Another way to look at shopping habits is to use the Highways England data that we saw earlier. What we've done here on the right-hand side is tap into some of the traffic sensors on roads going into some of the large shopping centres in England. Now, before doing this, you have to spend some time matching up shopping centres and whether there's any sensors close to them. And if there are sensors close, they have to be largely measuring traffic going into the shopping centre rather than somewhere else. Otherwise, it won't give you a good steer. So there has to be some groundwork first. So you can by no means do it for every shopping centre you can think of, but nevertheless, it might be informative. You can see here the data shows a pretty plausible story, a big hit from lockdown, but then recovering, but flattening off since then. Again, this doesn't go to the latest data. Now, there's lots of mobility indicators, as I said, which are out there, which you can do similar exercises with, or look at different aspects of mobility. There's some direct footfall indicators out there, like Springboard. You can get TomTom data on traffic by hour to look at commuting or late night journeys. You can look at weekday versus weekend spending with Locomizer data to look at working from home versus leisure activities and so on. So this is just a fraction of what's out there. But another thing to flag here is some of the issues that you get with faster indicators, which is reliability. You can see that right here, the swathe condenses to a single line. That's basically because some of the sensors weren't picking up readings at that time, or they returned no values. Now, we can't fix that ourselves. It could be a physical problem with the sensor in the road. So you have to be careful interpreting the signal at that time. As you can see, it did come back on a few days later. Now, what I've just shown you is pretty aggregated series, proxying activities in large swathes of the economy. But you can also use faster indicators to get a lot more specific and try and draw out economic stories. And here's a couple of things on London. So the left-hand side shows London Tube passenger data split by various stations. So I picked out Bank, given that's where the Bank of England is, but also because it's in the heart of the city. And as you can see there, tube traffic has remained very weak, much weaker than the other lines on here. It's a bit stronger at Westminster and Heathrow, but again, you can see Heathrow edging down a bit, which is consistent with the flight indicators that we just went through. The outer suburbs of London, which is broadly zone 3 and outwards, has been less affected. Now, all that tallies quite well with the chart on the right-hand side, which shows declines in Google mobility across different London boroughs. Clearly, it shows the biggest reductions in the centre of London. So you put the two together, the evidence from the Bank tube station data, for example, and you get this story of central London being particularly hard hit since COVID. Perhaps people working from home more, maybe less tourism into the UK consistent with the flights data, and that would seem to chime with some of the reports you do get from some of the retailers in central London. So again, you're using faster indicators to build a picture of what's going on in the economy. So what I've just shown here are a few, again, only a few of some of the available indicators out there. There's Facebook mobility data, Citymapper, TomTom, Boris Bikes, Department for Transport data, carbon dioxide emissions. There's loads of stuff out there which you can try and draw together to pull out some themes. One final indicator on this particular topic is also widely used open table restaurant bookings. You can see here people reacting strongly to the incentives from the Eat Out to Help Out scheme. However, then once that closed, it falling back again. Lockdown was announced just about here, so it does seem people went out for a final meal before lockdown, but then it's coming back down again significantly here again. So again, one of the things we're doing here is using mobility indicators to proxy spending. Even if we measure the number of people going to retail outlets and going to restaurants, we don't know how much they actually spent. So this takes us on to direct spending indicators, not proxies, but actually cash spending. So getting on to some of those indicators. Now here's a combination of both mobility data and spending data from Locomizer. Here's a measure of mobility, and here's a measure of spending. So this is a scatter plot of all of these are different areas, so broadly cities or towns. And this is the relationship between the two in mid-September. So you can see the relationship you'd expect, greater mobility going hand in hand with greater spending. But the relationship is by no means precise. It's not as if all the dots are on the dotted line, so things can differ. And that's the data for mid-September. What if you bring in the data from mid-April? Well, that's dramatically different. Even given the weakness in mobility, all of these yellow dots are below where that blue line would extrapolate it to. So spending was even weaker than expected, given what you would have thought given mobility. So the relationship between the two can change over time. You put a dotted line through those yellow dots, it'll be a lot different from the blue line there. So what can drive things like that? Well, the right-hand side is one potential driver. This shows the official data contribution to the level of retail sales over the last few months from online and in-store purchases. During the first lockdown, in-store obviously got hit very hard, given that non-essential shops were closed. And immediately, it wasn't offset that much by greater online spending. But it took people a couple of months to work out that actually to make those bigger moves to online spending, and that's broadly stuck since the shops reopened, although obviously they've closed again more recently. But what this means is that with greater online spending, there could be less of a link between mobility and spending than there was previously. People buying online, you can also do that from home. You don't have to go in-store to do that. And these mobility indices will be measuring the in-store components rather than the online. So those kind of things can change. That's one measure, one direct indicator. There's also other direct spending indicators as well. The left-hand side shows payments data from the bank's CHAP system. So this is essentially revenues from various firms using the system. Again, it doesn't go to the exact latest data. It's pretty close to real time, and we've divided up the firms within it into the different buckets of consumer spending that I went through earlier. Social spending, the weakest, staple spending remaining the strongest, delayables hit at first, but then coming back once shops reopened and people did move to online. So that draws out some of the themes I mentioned earlier. On the right-hand side, there's also other direct measures of spending from different debit or credit card providers, again published with a lead over official data. So this is the Visa Consumer Spending Index and the monthly Barclaycard report shown here. You know, the broad shapes are pretty similar to ONS retail sales. They're a bit weaker, but they will capture some of the weaker components of consumer spending more so than the official data. Namely the more social elements of spending. So that can give you an insight as well. So I'll just flag a couple more other slides before we start to wrap up. Here's a couple of things. So far we've been measuring consumer spending. Here's a couple of things on the income side. The first just uses, on the left-hand side, uses Google searches to look at unemployment and redundancies. You can see in normal times, some of these indicators really work quite well. If you get made unemployed or redundant, it seems plausible that you could go home, Google a few things about unemployment or redundancy, and that will be captured in the Google search data. Obviously, more recently, there's been some divergence in these indicators, but the official data in blue, you did get some signal from that from one of the Google searches. Often people Google other things as well. Google searches fit quite well with some components of consumer spending. Maybe people Google them and do a bit of market research before they go ahead and buy them. So that can provide an insight as well. On the right-hand side is some material from a CEPR working paper, which is referenced here at the bottom, using a consumer finance app. So what that app does is measure spending, but it also measures incomes, which is a very useful different angle as well. So what you can do is look at, for example, if somebody's main income has disappeared from one month to the next, that could potentially be a sign that they'd be made unemployed. Or if their income has fallen around 20%, maybe that's indicative that they've been furloughed. One of the other authors here, Sinem, works at the bank, so we've been working with some of this data. Finally, on the indicator side, to reference the ONS. The ONS are now producing a range of really useful faster indicators each week, which we use a lot. The latest one was out this morning. There's business survey data in there. The left-hand side here shows the proportion of workers on furlough or sick leave, which is obviously, particularly furloughing, being a key economic issue, both over the past and over the future. There's other labour market data in there. The right-hand side shows job vacancy data from the online platform and Zuna. This is just a couple of what the ONS are producing. There's loads of other stuff in there, online food prices, housing indicators, traffic camera data. So that's another source of information that we've been using a lot. So starting to wrap up, what have we learned from all of this? Well, the first thing is, why weren't we doing all of this before? A lot of this information was already out there, but a lot more of it has become available since COVID hit. Our old models worked fine prior to COVID, but faster indicators really can give you a more granular view on what's going on in the economy compared to some of the more traditional indicators. The second bullet, economists and data scientists can learn from one another. This has been a very educational experience from both sides. Keeping an open mind, we didn't know what was out there, we still don't. We still haven't reaped the full benefits of this, I don't think, so we will continue to look at these things. As I was saying, cast the net wide. As I said, COVID has had vastly different impacts on different sectors of the economy, so trying to get a handle on those is really important. But all of this is just a fraction of what the MPC look at to inform their decisions. There's a range of other stuff, credit conditions, financial markets, global economy, all of those things feed into their decision as well. And faster indicators don't really tell you about the medium-term outlook for the economy, which is obviously a key aspect for monetary policy. Not everything will work. We kind of went through whether sensors drop off or not. Some things we find useful at the beginning, but then we don't find useful later. The merits of adding a 9th mobility index to the original 8 you've got, the hurdle becomes higher. And as I was going through, iterate, automate these things and build on each other's work. Finally, what next? Well, to what extent will faster indicators become part of our normal toolkit is yet to be seen. Prior to COVID, we were looking to diagnose 0.1, 0.2 changes in GDP from quarter to quarter. It's yet to be seen whether faster indicators will be able to do that, or will they just be able to capture moves of +10 or GDP. As time goes on, obviously, the more faster indicators we have, the more ONS data we get to calibrate them against them, the more we learn. So maybe some of these indicators will be useful for the tails of the distribution, but not necessarily for the central view. But as we've touched on a few times, more collaboration between data scientists and economists does seem here to stay. I'll stop there. This has covered some of the indicators we're looking at. I could go on for a lot longer on other housing market indicators, labour market indicators, price indicators, things like that. But I will stop there and open things up for questions.
Thank you very much, Nick and Alastair. I think that's been a really interesting, fascinating presentation and given us a really good flavour of the range of work. And there's a lot of work you probably had to do at short notice because there was no real warning that you're going to have a COVID or a lockdown. So congratulations on that piece. I definitely like the way you described the appetite of use anything and everything. Faster indicators, alternative indicators, but I also like the way you delineated them. And I also like the fact that you use phrases like proxies. So there's a real balance there, which was quite appealing. And obviously, before I get onto some of the questions, of industries and businesses, unusually, we ended up with zero output. They just stopped, which is very unusual. It's not something that you can actually go back and look at recent times that's occurred. Not only global value chains, but national value chains broke down. So you've got a lot of change. So I'm going to take the chairman's prerogative, 3 quick questions. With your alternative indicators, faster indicators, obviously there's a comparison with traditional. The traditional indicators, the noise and the signal, is very different in such times. You can't work out what is one versus the other without a track record. Did you do work, or did you find it challenging, or how did you go about it, separating the signal, the noise, and the trend in the alternative indicators to better inform what you're doing? Second question, obviously, as time goes by, these faster indicators serve an appetite for users out there. And as the official data materializes, that may well be different and give, because it's greater official data content, etc. And in terms of our behaviors, do you see there's going to be any challenges, or what do you think will be the perspective when actual official data comes along and, let's say, doesn't agree or conform, or is very different from some of the faster indicators? And my third point, you've covered a lot of ground. Were there any challenges where you couldn't get any indicator for a particular part of the analysis of the economy or your policy analysis that you fed into the bank? Yeah, that would be an area that we would like to see, consider how we can get something. So if you want to try those, I can see now there's a number of questions coming through, and I'll sift through those in the meantime. Over to you, Nick and Alastair.
Okay, thanks very much. So I'll probably take those in reverse order. What are the challenges on what we found? So I think the biggest, well, first thing is we're certainly aware that there are blind spots in our faster indicators coverage. A lot of what I showed you is orientated towards the consumer with all the mobility indicators. It's much harder to come across faster indicators for the business sector. So if you think about GDP, you know, business investment is 10% of GDP. It's quite hard to come across faster indicators for that. One thing I haven't mentioned here is some of the other information the bank has. So the bank has their regional agents network. So, you know, we can get intelligence from them, try and get feedback from businesses, but it's not necessarily as quantitative as some of these indicators. So that's one, you know, blind spot which we would like to try and find more on the business side of things rather than the consumer side. So, well, business to business spending as part of that. Even within consumption, there's certain blind spots that, although we do think we have more covered on consumption there. What do we do when the official data doesn't agree with what we said? Well, you know, we do take the official data as the benchmark, so we have to rethink. You know, we are aware of some of these things. So these indicators might not be representative. Chaps, for example, maybe the firms in that sample are not representative of the economy as a whole, and that could lead to some divergence between the official data when it comes out and faster indicators. Some of the other spending indicators, maybe there's been a move to away from cash in the economy towards card. So some of the card indicators, have they been boosted by people using cards more rather than cash? That's a question we come to as well. So yes, it's certainly, you know, this morning we've got Q3 GDP data for components, so we'll be doing a lot of benchmarking there on how well faster indicators have performed compared to consumption in Q3. Signal, noise and trend was the other question. Yes, again, so I mean, there's various things come up. Seasonality in the data, you learn about that, you know, in the context of, you know, historically, you take your indicators for GDP from the ONS or something like that, which are, you know, real and seasonally adjusted, so you don't have to worry about it. A lot of these data are nominal, they're non-seasonally adjusted. You know, maybe some of the rise in the summer was because the weather gets better. You can think maybe that accounts for some of the changes in the walking mobility data. Will that get worse in winter anyway as the weather gets worse? You know, that's something to that we have to think about. The seasonality, you know, some of the data is seasonal at weekly frequency, other at monthly frequency, and it's mostly nominal, or some of it's nominal. Whereas you normally work with fully real data. So you're right, all of those are challenges that come up and you have to think about and just try and deal with as best as possible.
Just want to check, does Alastair want to add anything to yourself before I go open to the questions that we've got?
No, thanks. Let's press on to some other questions.
Okay. First one, just for information, that we will have, unless I'm corrected, the slides will be put onto the ESCoE website, so they will be available. I'm going to just try to group some of the questions. One of them is actually, you obviously have your agents around the country giving you lots of qualitative and quantitative information. The work you've done in this area, will this be built in to your activity, your models, etc.? This is one. Then there's the element of, it's probably a bit too early to say, but it'd be interesting to see how you're evolving in this. The predictive power of these indicators compared to, for example, the GDP figures. There's an element of present and past. So, for example, there's another question on some of these issues are tail events. What analysis are you planning to understand why these events have occurred, which may or may not apply in normal times? So there's a couple of themes like that in terms of moving forwards. What improvements would you put like in some of these in faster indicators? It's quite interesting that, like you said, you weren't doing it before, you are doing huge amounts now, and we're already considering what improvements. So I'll give you those for starters.
So what improvements, and also I'm just trying to read a couple of questions on the chat as well. So improvements in a variety of areas. As I say, that there's some of the blind spots if you think about those buckets of consumption, but also different parts of the economy besides consumption. I mean, you can think about all of this from the output side. If you think about it from the GDP output side, manufacturing, business services, have we got good indicators for those? I don't think so. If you think about it from the GDP output side, the most evidence we've got is kind of the really consumer orientated ones, like the restaurant sector, hotels, things like that. So that's another way into it. Can you do these things from the GDP output side as well as the GDP expenditure side? There's a couple of questions about, are we trying to build an aggregate indicator rather than having these 20 different things? Yes, I think we'd still look at the granular information because there's a lot of information bottom up as well. As I said, there's so much difference between the different sectors of the economy that you would want to do that. In terms of an aggregate indicator, there's kind of pros and cons. If just to use a polarized example, if all of our indicators were consumption, then that wouldn't be an indicator of GDP. It'd be an indicator of consumption. So you could use it as a proxy for GDP, given that it's 2/3 of the total. But if you've got blind spots, then you have to be wary of that. But yes, we do think about the aggregate message of these things. And as we'll have gone through, if you look at some of the charts, not all of these indicators, even for the same things, give exactly the same answer. Google mobility is not identical to Apple mobility, so you have to look at them all and take a judgment on that and try and get an overall theme. So it's certainly not the case that there's just kind of like a black box indicator model and press go. There is a lot of judgment trying to think about these themes. Hopefully that covered a couple of questions.
Yeah, that's fine. That's great. What I was going to do is I was going to open up if Eugene Chan wants to come in, because I think he's got 2 or 3 very good points and links that link the models to how you can take that forward. Eugene, if you want to unmute. Or can we get Eugene unmuted? Sarah?
In the meantime, perhaps I could just quickly answer the question about agent-based models and things like that. So we certainly do have research groups thinking about these kind of models too, working on those both from a research point of view and more sort of direct policy point of view. I think we'd be absolutely looking to try and bring some of these data in as well, but particularly once we've kind of had time, as some of the other questions are talking about them, to understand them more, to benchmark them against other data that we receive as it goes through, to really get a feel for what they are showing us and maybe what they aren't showing us before perhaps we plug them into some of the more complex models.
Thanks for that, Alastair. I'll try Eugene again. Eugene, are you unmuted?
I think he has a microphone. We can't hear him. He is unmuted.
Okay. What, Rosa Ruggieri? I don't know if you want to come in about your point about historical data. Rosa Ruggieri. Either is a technical issue or people are shy unmuting. I'll read Rosa's point out, then if we can't get hold of her. She's mentioned, how do you assess the quality? For example, have you been able to use some of the historical data to generate an overlapping period to see how the correlations make sense or make any value? Nick?
Yep. So this gets into the question about every time the ONS publishes the official data, we have to get into benchmarking it to see how well faster indicators have done. Fortunately, the ONS now produce monthly GDP, so we get a lot quicker read on where things are each month compared to quarterly, which was the case a couple of years ago. Another problem is in terms of can you match these things historically? The magnitude of what we're seeing now is unprecedented. So right at the beginning, it was clear that prior to COVID, we seem to have a pretty good mapping between some of the business surveys and the official ONS data. Lo and behold, it's gone out of the window now. So even if you can fit these things to the previous data, it's not necessarily the case that they will work now. So again, that's another part of learning about these things and calibrating them every time new data comes out.
Okay. There's another question from Peter Byron. In terms of your credit card data, instead of using just credit card transactions, it's linked to obviously granularity. Have you considered, or did you do any work on the different transaction types and maybe the different types of products produced and purchased?
So some of the Visa and Barclaycard reports we mentioned earlier, they do provide some disaggregation, so you can look at clothing or spending on cars and stuff like that. So that's the CHAPS also contains some detail about that. So even within those 4 buckets of social spending, work-related spending, delayable, and so on, you can start to get a bit more granularity on those things. What's done well and what hasn't done well, and again, taking some of the some of the reports which come out from retailers or the ONS official retail sales data, then yes, that does start to give you more of a feel for what's doing well. As people have been in the house a lot more, kind of home items seem to have done pretty well, but clothing doesn't, because lots more people are working from home. You don't necessarily need as many to buy as many clothes as you used to previously. So yes, you can try and draw out more stories like that.
So I'll draw on to the final question. It's linked to what you've just covered. It's from Rory McElliott. Apologies if I've got the pronunciation wrong. Credit conditions and availability for firms is an important focus at the moment. Have you looked at anything in this space, in particular, any gaps that are kind of emerging between supply and demand? And will that consider consequences and changes to inform policy or incentives, for example, for businesses?
So there's a couple of things on kind of credit conditions and availability. So that's one area where quite good data exists anyway. So, just looking at interest rates on credit cards, mortgages, by, lots of different types of mortgages, loan to value ratios, things like that. That data is quite readily available. So you can look at that in quite close to real time. The other thing we have is the Bank of England's credit conditions survey. So that gives us more information. Also from the lenders on, are you planning to tighten credit conditions, loosen credit conditions in different parts of lending, unsecured lending, business lending, housing, home buying lending as well. So we haven't covered those because I think there was kind of better information on that already available, whereas some of the things that we've covered today are areas which there was less available already, and therefore we've needed to make more of a push on.
Okay, thank you very much for that, Nick, and also Alastair. I think it's been a really interesting insight, something that's going to be ever changing, rapidly changing. I'd like to say thanks to the people who've asked the questions and all to everyone who's attended on the webinar. There should be another one in roughly 2 weeks' time as the series continues. And I'll bring this to a close. Thank you very much and have a good day wherever you are. Okay, bye.
Thank you.